Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and we're getting an update today from Justin Huhn, founder and publisher of Uranium Insider. And I believe he's the only one that's writing a dedicated newsletter to the uranium sector. And so we will put a link down below so you can follow along with Justin's work. But Justin, it's always great to get you on the KE Report periodically just to check in on the uranium market. I was telling you off mic, I've talked to a couple other people that are generalists or people that invest in the energy sector, and they all seem really down in the dumps about the price action in the mining stocks. But there also is some confusion about the news coming out of Kazatomprom in Kazakhstan as a major swing producer for the whole sector. And it's kind of been a mixed bag. So I want to kick things off today with just having you help us dissect the news and maybe for people listening, get a little clarity on it. We're hearing for the last 6 months or so that they're having problems getting acid for their ISR mining. And so that was going to crimp supply. And then a tax law came out that said, hey, the country is going to be raising taxes, and it's on some kind of a tiered tax system where the more they produce, the higher the taxes. So a lot of people thought that would discourage new supply. But then they come out to the market and surprise people with an announcement for guidance where they're going to actually produce more than people were expecting. And that caused people to even have more of a fit. So help us break down what's actually happening in Kazakhstan with Kazatomprom and also the JV that they have with Cameco.
Yeah, so the tax issue came up a few weeks back, and this was, in our estimation, a pretty significant update. This is something that Grant Isaac from Cameco in their conference call just last week mentioned that they were not consulted. Those are his words. They were not consulted on this. This was a surprise to them. And this is a really big change in the cost of production in the country. It's such a big change that, again, to quote Grant Isaac from Cameco's call last week, that this is placing Kazakhstan production costs relatively in line with their production costs in Canada and Saskatchewan. So these are, McArthur River, Cigar Lake, very large, very complex underground mines, hard rock mines that have relatively low production costs compared to some of the lower grade projects in, let's say, Australia or Namibia, et cetera. But Kazakhstan has always been the low cost producer, including all of the joint ventures. So this new tax is a progressive tax, but it's not a marginal tax. So any project, basically, and it goes in tiers based on the annual production level in tons. And every tier that you step up another 1,000 tons per year for that particular project, that raises the overall tax rate for every pound that comes out of the ground for that project, and all the way up to projects that are above 4,000 tons a year, which is about, let's say, about 10, a little bit more than 10 million pounds a year. Those projects will have an 18% tax when prior to this being implemented. I believe this gets implemented January 1 of next year. Prior to that, it was a flat tax of 6%. So not only do you have a much, much higher tax rate for pretty much all the projects in the country, but you also have a sales price of uranium additional tax rate. So the largest projects could see upwards of a 21% tax rate, whereas just currently and until this is implemented, there's a flat 6% rate. Now, Kazatomprom is essentially state-owned, and these taxes will be paid to the state. So for Kazatomprom's 100% owned projects or their portions of the joint ventures, it's sort of right pocket, left pocket. But for their joint venture partners, this is a big impact on their production costs. How will this affect incentives for those joint venture partners going forward? It remains to be seen. But another really interesting element of this is that Cameco reported that for the first half of this year-over-year production at their joint venture Inkai was down over 18%. That's a really big drop for this asset. And the Inkai project it's an unbelievable ISR asset. It's the tier one asset for ISR if there ever was one. This has been a very consistent producer. It's very large, producing, Cameco's shares, 8 million pounds a year coming out of this. This is a very large project expected to produce for like another 20 years at these levels, right? It's just massive. So for that to be down 18%, and then to have Kazatomprom with a trading update the following day last week say that their production has actually increased by almost 6% year over year on a 100% basis, which means all production in the country, considering the Inkai is down 18%, but on 100%, they're up 6%. That's quite the tell in our estimation. And from what we can tell basically what this is looking like is that the Chinese and the Russian joint venture projects are getting prioritized in terms of potentially not only sulfuric acid availability, but also possibly with skilled labor force and other key elements that they need to progress these, whether that's piping, whether that's drill rigs, et cetera. Importantly, with the increase in production that they are reporting year over year, as well as their expected guidance for production for the year, which they increased by about 1,500 tons. It's about a 3 million pound increase of expected production out of the country on a 100% basis. We believe that most, if not all, of that increase is coming from the Budenovskoye 6 and 7 deposit. We'll have clarity on this in a couple of weeks when they have their Q2 conference call. But this project is a joint venture with Rosatom, and Rosatom is Russia state-owned, and this project is already committed the ramp-up phase for this year, next year, and 2026. Every single pound coming out of the ground from Budenovskoye 6 and 7 is committed to Russia for their civil nuclear program. Russia has over 20 nuclear power plants in construction around the world. Currently, right now, they have the biggest export program in the world. And these export nuclear power plant projects, they build the power plant, they train the workforce, they fuel the reactor for its life, they deal with the waste from the reactor for its life, and they decommission the plant. And it's kind of soup to nuts. And part of that fueling, obviously, is uranium. So they have a lot of conversion, they have a lot of enrichment. The Russians don't have a lot of uranium. They need more uranium. And these key projects in Kazakhstan are their best assets for U3O8, for uranium. So in our estimation, a small incremental increase on a 100% basis out of Kazakhstan that is very likely to most, if not all, go to Russia makes absolute zero difference to us in the near term or even the midterm for this thesis. In fact, ourselves and all of our colleagues whose modeling that we've been able to see, everyone is modeling and expecting incremental increases coming out of Kazakhstan. So this was not a surprise whatsoever to us. And we think the market utterly got this wrong. And so that's why we've been, or I guess I personally have been relatively aggressive on the long side in the last few days with the market turmoil. We've got some serious chart damage here. And of course, we had, Thursday morning following the Kazatomprom news, with which the market interpreted as bearish, we had the stocks open up, gap down, maybe 3 or 4%. But about 30 minutes into trading is when you started to see the Russell 2000 and the NASDAQ and the S&P just completely do a nosedive. When that happened, then what would have been probably a 3 or 4% down day ended up a 7% down day. It's followed through on Friday. So technically damaged, but here we're looking at, we think this is an unbelievable buying opportunity. Whether or not this is the bottom, I don't know. I don't have a crystal ball, but I can go back and look at the charts 5 years back and tell you when you see RSI 25 for URA, URNM, either that was the bottom or the bottom was found 3, 4, 5% lower over the next 2 weeks to 4 weeks, every single time for the last 5 years. So is this going to be the same? I don't know. All I know is when it's easy to buy and when the oversold nature is as drastic as it was and continues to still be, and the outlook for the sector looks very, very good for the remainder of the year and into the next few years. We think this is an incredible, incredible opportunity. We did not think we would see these prices again.
Yeah, Justin, that's a great summary. And it's a great summary of some of the action we've seen in the pricing just since the end of last week into this week. I was going to ask you if you thought the general U.S. market rout triggered by the Japanese stock market selling off even worse on Monday, but it started the end of last week, if that was affecting the uranium stocks in sympathy with the overreaction to the news out of Kazatomprom's announcement that they would be increasing by 6%. That's also a pretty big revelation that if the Cameco's JV project is dropping by 18% in its expected output, but they're overall going up, that uranium that they are mining, like you say, is really going to Russia. That doesn't affect utility buyers here in the States or in Canada or in a lot of European countries. Maybe talk about the nuclear fuel cycle and what the lay of the land is right now with the utilities. I would imagine that all of that news about Kazatomprom ramping up production doesn't mean anything to them, but how are you reading it as far as the utility companies and the fuel cycle side of the business?
The utilities, I imagine, probably feel a little bit of a sense of hope hearing that there's going to be another few million pounds. I don't think the utilities do 5% of the work into the actual supply situation as investors do. So the utilities sort of, I mean, there's a few standout utilities and fuel buyers that we speak to that are on top of things more than most, let's say, who do see the writing on the wall, who are expecting higher prices to continue for the coming years, who are seeing the demand picture grow incredibly, and are doing what they need to do to make sure that their utility is covered. So there's a few of them, but for the most part, they generally act sort of like herd animals. And this is not this I'm sort of quoting a CEO in the space when I say that, but they sort of all move not in unison, but they kind of take cues from each other. So in our estimation, when a large utility will come into the term market in the next 6 months and secure a long-term contract, let's say late 2020s, early 2030s, for multiple millions of pounds at the current prices, that's going to be a big signal for the rest of the sector that we accept this pricing environment that we're in right now, and we're going to get it done, and we're going to make sure that we're covered. So over the past 6 to 8 months, it's been very, very quiet up until, let's say, the past 6 weeks. We've started to see activity increase in the term market. There's only been a few million pounds that have been signed in the past during that period of time. So the actual official inking of those pounds continues to be very slow. We expect that's going to change drastically in the second half of Q3 and into Q4 of this year. We think we're going to see potentially more than 100 million pounds added to the long-term contracting volume for the year by the time the year is out. Why do I think that? Well, there's more than a dozen utilities that are actually being reported by the price reporters that are currently in contracts or RFPs, contract discussions or RFPs. So they actually have an RFP out, let's say, with stated volumes and delivery years that they make public. There's a few of those out, but most of the discussions, the volumes and the timeframes are not shared. And there's plenty of utilities having quote unquote off-market discussions with the producers. So, and this is in August, right? In late July, August, if we're seeing increased interest in this level of conversations happening, that's a very, very good sign. So they've been quiet year to date, though, in terms of actual volumes being secured. There's multiple reasons for that. I'm sure that we touched on this a little bit in the last interview, but basically we've had a number of factors coalesce that have led to this quiet term market and quiet spot market. July of this year, the volumes traded in the spot market was the lowest volume for a single month in the spot market in more than a decade. That's how quiet it is. Leading up to this year, we had a couple of things happen. One, we had the spot price double and the term price increased drastically. So the spot price went from the 50s to $106 from July to January. So in 6 months, we had the price double. That's a historically gigantic move. And that is something that utilities are not going to absolutely run and chase unless they feel that it really is game on and they're not going to be able to get filled otherwise. So if you see the term price continue to climb up, and it's sitting now at $79 as reported by UXC, 82 reported by Trade Tech, the spot price is right there with the term price. And we don't think the spot price is going to fall much from here because of that reason that the term price is right there. So you've had this big price move that utilities are not going to want to chase. They're going to step back and see where it settles out. All right. So it went from $50 to 106, settled back down into the low 80s. That is a very, very higher low that this spot price is making. That's incredible to see it not pull all the way back, maybe just $5 or $10 before the price it was hovering at before this move. So to see it pull back as high as, 80 to 85, even to $90 in that range is incredibly positive and a very, very important tell. And all the while the spot price spiked and pulled back, the term price keeps climbing. So this is the other really important point, Shad, is that the term price is up. If you're going by Trade Tech, it's up about almost 20% for the year so far on very, very low volumes being secured. So low volumes in the term market, but the price keeps climbing. That's really important to understand. So what did we have? The price doubled and pulled back. Utilities stepped back, not wanting to chase that. That's one factor. The other factor is the utilities did a lot of work last year and the year before, but especially last year, to make sure they're covered in the near term. So what did they do? They flexed up on legacy contracts, electing to receive as much as they possibly could in these legacy contracts that at least were partially fixed price. And of course, that fixed price in contracts signed 2, 3, 4, 5, 6 years ago, way lower than what they would have to buy in the spot market right now, right? So every utility did this to the extent that their contract allowed it and will continue to do it as those allowances in legacy contracts do continue. Now, those are going to taper off because we know that once we started to get into this pricing environment where the price was clearly in an uptrend and it was shifting relatively quickly to a seller's market, the sellers largely stopped including flex provisions in the contract. So the option to flex up is diminishing. And in the next year or two, it'll be gone. So that's what we're looking at. That's one lever they pulled, and they're not going to be able to pull it for very much longer. Flexed up, sitting out based on the pricing rise and spike that we saw. Lastly, pulling forward material, primarily in the United States, we're talking about material from Russia. So since the invasion of Ukraine, there's been talk about sanctions of Russian material. So the US utilities have been focused on this for the last 2 years. Finally, there's clarity there, and clarity is the most important thing. Even regardless of how the sanctions settled out, we know how they settled out. Russian material is effectively banned next week. It will be illegal to import it without a waiver. And following at January 1, 2028, it'll be illegal no matter what. So they've been focused on this, and what did they do? They pulled forward as much material as they could from Russia last year and the year before. These are contracts that, let's say, had deliveries for the next few years, and they did what they could to accelerate the deliveries, just to make sure they could be covered in case the material was sanctioned. So all of these elements have allowed the utilities to be quiet in the market, and the volumes are showing that that is the case. So that's where we're at now, and all of these levers are running out. We have clarity on the Russia situation, increasing clarity on the waivers, although it's still a little bit of a mess. We have the flex provisions diminishing in legacy contracts, and we have the price stable. The price stable in the 80s when it was $50 last year. Incredible to see it that much higher, 60% higher than last year is where it settled out after a price spike. So all of these things are leading into what we think is going to be a robust end of the year in the term market. I think that's going to keep moving the price up significantly. We should see the price start to move pretty soon here. Will that come after the Kazatomprom Q2 conference call? Will it come after the WNA conference in early September? Hard to say exactly what's going to trigger it, but it's going to happen. And what we saw last week after the Cameco conference call is 7,000 or 8,000 pounds traded in the spot market, which is historically not a lot. It's a decent day in the spot market. And the price jumped up $4.50 on that volume. And that was Wednesday, just Wednesday, late morning into the afternoon. So it's not going to take much buying pressure to move the price. And that buying pressure is on its way. It's coming.
Well, that's a great summary, man, of what's going on with the utility companies, that the flexing up period's coming to a close. It's nice to see the term pricing creeping higher and higher, getting closer to where the spot was. And even though it's been quiet, I liked how you outlined why it's been quiet, but that's also not going to last forever. And those waivers aren't going to last forever. And there is a point where they won't even be able to bring forward any more Russian supply. So I know a lot of the utilities are still looking for clarity on the waivers, but I want to switch over to maybe more the supply side of things and get into the mining stocks. But before we dive into that part of it, I got to ask you about some other news that's happened since we've talked last, Justin, and that is one of the big projects that's been sitting on the back burner for a long time was actually in Australia, the Jabiluka uranium deposit, and it was Energy Resources of Australia, which really is 85% owned by Rio Tinto, that had been hoping to be able to bring this deposit back into production. I think it was originally in production as the Ranger deposit, and this is very close to that and part of this giant complex, but it's been officially turned into a federal park, and it's banned forever now. And that was something that everybody always threatened could come back online. And so I'd like to get your thoughts on that, but also the situation in Niger hasn't improved. So you've got Australia and Russia, and to some degree, Kazatomprom is signaling more output, but maybe not so much with Canadian partner JV projects. So it looks like everywhere we turn, there's a perfect storm of supply destruction or not coming online. What do you make of the supply side of the business from the mining companies?
Mining sucks. I mean, nobody wants to build a mine. And with that said, you do have some of these large back pocket deposits like Jabiluka, like Imaurin and Niger, that permit was taken away from the French in the last couple of months. These were both very, very large projects. I don't think anybody really had Jabiluka as producing in this cycle. In Marouin, we started to hear some grumblings. I know that the French were testing ISR for a minute there, but there's a lot of animosity towards the French in Niger right now, and what the future holds for Orano in Niger is anybody's guess. What will happen to that deposit? Probably it'll end up in somebody else's hands eventually to be developed. It's not, this was one of those projects where development stopped in the early 2000 teens because the price started to fall. So it's not a low cost project. We do know that the Chinese are starting to kind of turn the gears on getting Azalec into production, also in Niger. And this is a very high cost project, and the Chinese need uranium. They're building reactors like absolute gangbusters right now. There's a Bloomberg article that came out yesterday highlighting the sheer pace of the Chinese build out is really phenomenal. I don't have the number right in front of me. I believe there's 25, 26 reactors under construction in China alone, which is almost half of the global nuclear fleet under construction, 60 reactors under construction, which is incredible. We're starting to see the total number of reactors under construction. That number keeps growing. This time last year was 54, 55 reactors. So happy to see that despite, all of the stories of nuclear, the pace of nuclear growing and nuclear being the answer for X, Y, and Z, clean energy, baseload energy, AI data centers, whatever it might be, that seems like just a lot of wishful thinking, but the actual number of reactors under construction continues to grow, which is really good. The supply side is tricky. There's a number of projects that have been impacted, Global Atomics DASA and Amaurin in Niger. Jabiluka, like I said, I don't think it was on anybody's modeling to be producing this year, but it's just one of those things that it doesn't look good to see these deposits being taken away or being ixnayed by the powers that be. We are seeing supply slowly respond from existing producers and brownfield restarts, right? So Paladin, it looks like they're not going to hit their production goals from their restart in Namibia, but they are restarting, so that we're getting some pounds out of Namibia there. Uzbekistan has been able to increase production a little bit. We'll get an extra 500,000 pounds a year out of them year over year until we hit, maybe 12, 13 million per year by the end of the decade. And whereas now where it's about 10 or 11. The Kazakhs, everyone expects they'll be able to increase production, marginally year over year as sulfuric acid becomes more available. The US ISR projects are slowly coming online, a few 100,000 pounds, from various producers in the United States. And then Cameco has yet to confirm whether or not they're going to expand and get to nameplate capacity at MacArthur, which would be 24 million pounds a year. I think that they will do that eventually. But all of these projects are marginally increasing production, whereas this year we've got, 155 million primary supply, let's say, more or less a few million pounds, give or take a few million pounds on upside or downside from that number. But, next year we'll see probably another 5 or maybe 10 million pounds of supply, but we're also going to see increasing demand. So demand this year, depending on your tails assumptions, but our tails assumptions, we should see about 190 million pounds of demand in 2024. And if you go out using WNA's forecasting, even with the base case, we're looking at, we're looking at about 275 million pounds of demand per year by 2040. And the upper case, which is honestly looking more like the pace at which we're growing, we're going to see north of between 300 and 350 million pounds per year of demand by 2040. And it's just going to grow year over year by then, because we're seeing life extensions across the board in the United States. We're seeing reactor restarts in the United States. We're seeing life extensions in Japan. We're seeing life extensions in France. We're seeing new builds in France, restarts in Japan, and the Chinese are going nuts. India is building at a very, very fast pace as well, largely with the help from the Russians. They like these heavy water reactors, and they like these VVER reactors that Russia's design. So the build outs look positive, and yes, supply is slowly responding, but the supply response according to our models is relatively in line with demand. And unless and until the very large projects come online and or Kazakhstan can ramp up. So if we have Arrow producing and Phoenix producing and DASA producing, and Kazakhstan has ramped up to 75 million pounds a year, all of that combined could reach a balanced market by the end of the decade if everything goes right. But again, that's like a moment in time where things are balanced. Arrow's only going to produce that, high 20 million pounds per year for 5 years. Phoenix is, what is it, 8 million pounds a year? That's for 5 years. So these projects are short-lived, even though they're high volume, high grades. And we have decline rates in every single mine that's producing right now. Cigar phase 1 is going to be done in the next 2 or 3 years. Now they are planning on expanding into phase two. Our understanding is it's a little bit high, lower grades and more difficult mining, but they'll probably be able to pull it off. With all of that said, the supply demand picture looks very, very promising for the mid to the long term, and especially for the near term with a 40 million pound deficit this year alone. So there's nothing that we're seeing out there, Shad, that suggests to us that this is anywhere near over, nor that we are going to see pressure to the downside in the price of uranium. And I think all of the evidence is out there that supports that. You see low volume transactions being done in the spot and term market, yet the price is holding in the 80s after it was $50 last year. Incredible, incredible tell for what's about to come.
Well, I want to jump on a point that you just made, and that is that in the US, we are seeing some ISR production coming online, but it's not enough to really move the needle. So, there's a half dozen US producers, most of them ISR, although Energy Fuels does have the hard rock, but you've got Encore, you've got UEC, you've got Peninsula, even Cameco has some ISR assets in the US that may come back into production, but you are seeing the most of the increases with Encore, Energy Fuels, Your Energy, Peninsula, UEC. But that's kind of like we say a pimple on the flea. It's not enough to really move the needle. It's great for domestic supply in North America. But when you look to Canada, and you brought up Arrow, and for those listening that are not familiar, that's NextGen's project, or you brought up Phoenix, that's Denison's project. Those aren't anywhere close to coming into production this year or next year. Most of those are 2027, 2028, or some people think it may even take longer. But there's not enough production that's going to come out of Canada to move the needle. And maybe the Niger situation gets resolved and DASA can come on, but it doesn't seem like anything is imminent, Justin. So am I understanding that correctly, or is there something that could come online this year or next year that we haven't talked about?
Nothing meaningful, no. It's incremental. The US situation, assuming that we have continuation of a high price environment or higher price environment, that we're going to see marginal increases in production happening out of the US. But it's in 5 years, maybe we'll have 5 million pounds on an annual basis, maybe in the next 4 to 5 years, if everything goes right for all of the developing projects and the restarts. Canada, the same thing. It's only the existing producers, which is basically Cameco and their JV with Orano, to increase MacArthur. That's pretty much all they can do up there in a short time frame. They could bring Rabbit Lake back online. They could bring their US assets online. They have not announced any of these things. So we're still multiple years away. There isn't anything in the near term that we can see, Shad, that's going to satisfy this supply deficit. So multiple years down the road, if we see again, continued expansion in Kazakhstan and increased production there, which will eventually happen. And they need a lot more sulfuric acid, and they need the processing facility that needs to be built at Budenovskoye still. All the production out of that is being processed at a facility at another project. It has to be trucked over, piped over. So once that is up and running, once their other sulfuric acid production facilities up and running, then they can go from 60 million pounds up to 70, and not in a single year, but they'll get there. They'll get there eventually, right? And everybody is modeling for this. But in order for like the big projects like Arrow and Phoenix and DASA, the DASA, at least that mine has started to be built, but they still need to build a mill, and they still need money. They need to finance this thing, and that's been very, very difficult for them, as I'm sure you're aware. So yeah, Arrow, they haven't even broken ground on Arrow or Phoenix in Saskatchewan. There's some other projects around the world. Olympic Dam, BHP's Olympic Dam is primarily a gold and copper mine that has a uranium byproduct, and we'll get a little bit more out of that if we see continued high prices for gold and copper. But it's just these marginal increases that don't really solve the big supply deficit, and that won't be solved unless and until all of these other projects that I've just mentioned are producing. Now, of course, if we have a change in the demand outlook for some reason, then the story can change. So it's not set in stone. But what's interesting and what's unique about the uranium sector and the nuclear sector is that it's pretty easy to model demand. So whereas you could see like oil and gas demand can be drastically affected by economies and recessions, it's not the same for uranium. These assets are built, they're running, they operate at very high capacity factors. And it's relatively easy. I mean, it's exhaustive, but it's relatively easy to model out all the existing reactors when they're running, when they're expected to shut down, whether or not you believe they're going to get life extended, and what's under construction and when is that hitting the grid. And you base that, you can get your demand figure off of those numbers. So it's pretty easy to see what's going to be consumed from primary reactor fleet demand 5 years from now. And if you do that, then you can clearly see there's a supply problem. And that supply problem doesn't get better unless and until all of these projects are either up and running and or ramped up. And like I mentioned, from there, the demand picture as we see it now looks incredibly robust for the 2030s. So you even have Kazatomprom telling the world we need another Kazatomprom. I mean, that's really the reality of it. If we want to expand nuclear to the extent that many are expecting that we will and or should, we need way, way more supply. All of that is to say, Shad, that if we see $150, $200 plus uranium and it stays there for years, we're going to see supply respond sufficiently eventually. This is not a situation, I don't think, that is going to be super high prices in perpetuity. It's going to be cyclical like all commodities are. The opportunity is that right now we're looking at a big deficit for many years, and there's a big if whether or not that deficit will be satisfied with new supply. Will Arrow be able to produce on the timelines that they say? Like the company is going to tell you, second half of 2027, they're going to have first yellow cake in a can. If you go to, one of the banks that covers the stock, they'll tell you 2029, 2030. If you talk to some of the investors in the space, they'll say 2031 is where they have it in their models. So it's a big question mark where this new supply is going to come from and whether it'll come on time and on budget. And mines never are done on time, on budget. So it looks very positive for at least the next few years. And it's sort of a moving target. We're going to have to watch it. But we see an incredible opportunity here because it's very, very clear that supply is not going to be able to satisfy demand for at least another 4 years.
Yeah, that's definitely the picture that's setting up. And you took the words right out of my mouth that none of these mines ever happen on time or on budget. I shouldn't say never, but they rarely do in the mining sector. It's different if you're in an oil and gas company, you can drill a well and have liquid coming out. It's a lot different issue to inject fluids into the ground and do ISR in Saskatchewan, like Denison's going to do with Phoenix, where it's never been done before. So that's a big if. Now, they have done some pilot work, but we still don't know if it's going to work at a commercial scale. Arrow and NextGen may be signaling 2027, but to your point, most other people I hear are signaling several years after that. So it doesn't look like it's happening in 2025, 2026, and it may not even happen in 2027. And then there's the whole issue of everybody thought fission, the Triple R deposit, Patterson Lake, and Arrow would be developed in tandem. And then Paladin came in and bought fission. How does that change the math on that whole area, in your opinion?
It's hard to say. The deal hasn't officially gone through yet. I think that the management at Paladin, if we assume that it goes through, will potentially be more aggressive and competent in getting that over the line and getting that project developed. But that one is a little bit more technically difficult than Arrow, even though Arrow is much, much deeper. They don't have any water intrusion issues that could potentially be the case at PLS. So hard to say on that one. I mean, I think that eventually that'll be a mine. The grades are very, very solid and it's a shallow deposit. I know that a lot of fission shareholders have said forever that NextGen should take them out. NextGen should take them out. And for whatever reason, they haven't. So I don't know really what you want to draw from that. But, there's no shortages of discovered deposits. There's no shortages of uranium in the ground. But you can look at this present environment, especially, I mean, looking at producers that have already built these multi-billion-dollar underground mines. Okay, we're talking about, let's say, MacArthur River and Cigar Lake in Saskatchewan, to give you one example. They, in some cases, have to continue to come out still now to this day. Grant Isaac at World Nuclear Fuel Markets back in June, speaking to a room full of US utilities. Guys, we're not expanding anything until you pick up the phone and call me. They've secured a lot of contracts in their long-term contract book going out for the next few years, right? Going out 27, 28, they're pretty much sold out. But that's tomorrow in this industry. They want to sell out into 2035, and they're nowhere close to it. And they're not going to expand production into a market that is going to bring pounds into the market that will potentially influence the price lower. That doesn't help them. So when you have how can I say this? It's not combative, but the producers are here wanting this price environment, went through absolute hell in the 20 teens. All right. Cameco had McArthur River on care and maintenance. They cost them $10 million a month to keep that mine on care and maintenance. They had to shut that thing down, keep it on care and maintenance, keep the freeze walls up and running, fire a bunch of employees, hopefully be able to hire them back at some point, buy uranium in the market. They did all of this just to stabilize the market sufficient that they didn't go under and to try to get the price back up to some reasonable pricing environment where they could bring a mine back on eventually. Utilities couldn't give a damn. They were not contracting with Cameco in sufficient volume for a very long time because they could buy hand over fist in these carry trades, buy in the spot market, buy from the Kazakhs and the Uzbeks and BHP offtake at much lower prices. They could not care less whether or not McArthur River stayed in care and maintenance perpetuity. It's not their job, okay, to really support the industry and take one for the team and pay higher prices to the developing companies or the producing companies that had care and maintenance projects. And now we're barely in a better positioning here, even with prices far, far higher than they were a few years ago. So who wants to build a mine? Who wants to take the financial risk, $500 million to $1 billion or possibly more to build a mine, go through all of the hell of actually physically doing that, securing skilled labor when there's barely any to be found to actually pull the material out of the ground, do all of this if you don't have long-term contracts on your books that are going to de-risk that project. Nobody is going to do this. Nobody is going to do this. I know that the next gens of the world will say, well, our all-in sustaining costs are going to be, $7 a pound or whatever. It's dirt cheap, right? The grades are so good at that project. And I'm just throwing that off the top of my head. I don't remember the exact price of that. But they're not going, trust me, they're not going to do this and then just sell 29 million pounds of uranium into the spot market and crush the industry that they need they need to hold up. They're going to be signing some contracts. Maybe they're market reference contracts, but they're going to be contracts nonetheless. So it's not an easy industry. It's not an easy industry. And you can ask any old school guy who's been around for the last 30 or 40 years, who's been through a few of these cycles, if they expect all of these mines to come online on time and budget, they're going to say absolutely not. It's not going to happen, period, the end. And so, I'm telling you right now, some of the projects that we and others are modeling to be producing late, 28, 29, 30, 31, they're just not going to happen ever. So the companies all tell you the best case scenario. We're in the lowest quartile. We'll be able to produce 18 months after the final investment decision. We have the support of the government. We have the financing in place as soon as we pull the trigger. Like, they're going to tell you a perfect story about their brilliant deposit. Some of these projects will never see the light of the day. And in fact, most of them won't. So it's one thing to model things out and give a rosy picture and still see a deficit. It's another thing for that reality to come into play. So that's what excites me most, is to be able to watch this unfold as the years pass. And despite the fact that supply is not responding fast enough, the demand picture is even more exciting. It's truly remarkable to see what we're seeing, to see SMRs. I mean, almost every week we're seeing an announcement of more GE Hitachi BWRX 300s being signed, MOUs being signed with various countries. It's a brilliant, brilliant setup for nuclear, and I couldn't be more excited about it.
Well, Justin, I want to get into SMRs, but I've got like two or three questions that are on my mind just after what you just said. So maybe let's do a rapid fire segment here, and I'll just ask you some quick questions and
Sure.
just give me a quick response, because then we can dive through a lot of this. With the
Yep.
fission, Patterson Lake, and with the Arrow, do you think that they need to be developed together because of the road access and all the infrastructure that needs to be in place?
I don't think they need to be developed together, but it's highly likely that something could be worked out between the two companies during the development process. But to my knowledge, there's nothing pointing to that happening as of now.
You mentioned that, as an example, McArthur River and Cigar Lake with Cameco were two examples of underground mines in Canada. Are there any other examples besides those? Because I can't think of any other mines that are actually producing right now in Canada.
No, that's it.
So there's not any other Canadian supply. With the Denison Phoenix project, do you think that this ISR move is going to be effective? They also have hard rock assets, but what is the ramp up, or what do you think the likelihood is the ramp up that we get that done in a couple of years?
The time frame is probably unlikely, primarily because this is first of a kind. So there's always a lot of questions around first of a kind. They've already proven that it works. I do think that they will be able to mine this ISR, but they also have an ace in the hole in that they have a minority stake in the Sabre technology that Orano has started, and that's the surface access borehole recovery extraction. This is where basically you can drill a borehole down into the high grade deposit and do jet boring, just basically as the drill hole goes down to the deposit, they jet bore in a circular fashion and can suck out the slurry out of the same borehole. It's very, very cool. Orano's testing it. They're actually using it right now at McLean Lake deposit and McLean Lake mill. Maybe they'll get 500,000 pounds next year out of this deposit. So, and Denison has access to that technology, and Phoenix is a perfect deposit for this technology. There's a number of others that are ideal for this too, like ISO Energy's Hurricane is an absolute perfect candidate for Sabre. So they've got Sabre in their back pocket if they can't pull off the ISR, and Sabre's already approved because it's being used by Orano.
Okay, I was going to ask you about Hurricane too, like if it would come online because it's a high grade deposit, but you kind of alluded to it there. What about Orano? Are they going to, I mean, I know they're looking at that, but are they going to actually start ramping up production?
Orano is a tricky one. They're having problems in Niger. They're having problems in Mongolia. Canada is the best case scenario for them. They've got, like I mentioned, Sabre happening at McLean Lake. They also are looking at additional project joint venture in Kazakhstan. So hopefully they'll be able to get that going. But they've certainly had a rough run of it in terms of uranium production over the past year and a half, and which is why they've been all over the place trying to secure deals in Kazakhstan and Uzbekistan, and Mongolia, trying to shore up things in Niger, although it doesn't look good for them. But yeah, they're still a main player across the fuel cycle.
The US producers are at least in production, and so while that might not be a lot, on a percentage basis, some of them are signaling they could go from 1 million pounds to 3 million pounds in the next 2 years, or some of them are saying they could go from 2 million to 4 million. And I sat down with Scott Melby in May in Washington, D.C., and we added up almost 25 million pounds of supply that could come out of the US if everybody does what they say they do and if everything goes as planned. Do you think that gives US producers an edge right now because at least they're in production?
I think the U.S. producers have a very good edge here. Not only are they operating in the market that's the biggest demand market with the U.S. nuclear fleet, but there's also sort of this bonus demand that we could see in just a few years. We're going to see sooner than that a little bit of demand coming from the US government, but there's multiple factors. And Uranium Insider members had access to a webinar last month, and I won't mention the guest, but he went into this a little bit deeper into this demand picture from the US government. And there's going to be programs that nobody's aware of that they will be mandated to buy US sourced, US produced uranium. So US military can only use US produced uranium. So we could see some military demand. We could see some strategic uranium reserve demand. And of course, we have the enriched uranium RFP that's out right now. So a decent amount of demand is highly likely to be coming from the US government in just a few short years. And the US miners are going to benefit from that. As far as the total production levels, I mean, look, there's an enormous amount of uranium in the United States, much, much more than most people think. There's the area in New Mexico and northern Arizona has much, much higher grades of uranium, just very difficult to mine there. I mean, we're already seeing what's happening with, trying to move material from northern Arizona to White Mesa for energy fuels. We're seeing protests from the indigenous people there. And there's, these high grade breccia pipe deposits that the USGS back in the 1990s, they made an assumption there's 1 billion pounds of uranium in northern Arizona. And is it ever going to come out of the ground? No, it's not. So are we ever going to see 25 million pounds come out of the ground in the United States again? Probably not. I don't think that's going to happen. Could we see 10 million pounds in the next 10 years? Sure. I think so. We've got, 5 or 6 or potentially even more operational ISR processing facilities, one operational mill for hard rock, potentially a second if with a lot of refurbishment capex. So there's a lot of potential in the United States, but it's just going to take time for these projects to develop. It's going to take a pricing environment and a market that supports it. And it's going to take, a market for the equities to allow for financing without unbelievable dilution. And right now, that's not looking very good. And we saw a couple of financings announced over the last few weeks that were incredibly poorly timed. I'm not going to mention companies, but it's a challenge. But yes, I think the US is a fantastic place to be invested in with the US developing and producing companies for sure. 100%.
Now, what about with exploration? Because most of the money is going into the ground in Canada, in the Athabasca Basin, and even the Thelon Basin. But as you mentioned, there's already a ton of uranium that's been found in the United States, and the problem is being able to extract it because indigenous groups, in particular the Navajo, are very against it in New Mexico and in parts of Arizona. Is there even a reason to invest in U.S. explorers at this point, or would you put your exploration focus in Canada?
There's a couple of small cap US explorer companies that I think are interesting and worth looking at. They're primarily doing exploration in Wyoming, which is by far the best jurisdiction in the United States. So I think it's worth looking at. Yeah, like you mentioned, the exploration companies in the Athabasca are probably the primary exploration companies. I don't really think we need sort of an exploration revolution. Yeah, there's a lot of people highlight how bad the bear market was in the 2000 teens by showing the level of collapse of money being spent on exploration in the uranium space. But in my opinion, there's plenty of already proven out reserves that just need a market sufficient to allow for development. And that's, 5 to 10 years of $100 plus uranium and a lot of contracts being signed with development companies. And all these projects are mostly, 99% of them will never see the light of day. So I don't really think we need a lot of exploration, but of course the exploration companies, small cap companies, when they get a hit, you can make a lot of money as a speculator on that. It's just a very, very, very tough game, especially if the companies are too small to be held by the ETFs, then they miss out on those flows, the secondary flows that come from the ETFs. And that can really move the small caps up sufficiently because these drill programs are not cheap. So if you got a $5 million market cap company, you got to do a $2 million drill program. That's a lot of dilution. So it's a tough game. It's a tough game. And we generally stay away from the drill plays for that reason. But if you do some work and figure out ahead of time before a company hits or when they first hit, you can do very well speculating on that.
Well, let's make this the last question then, and let's talk about the drill plays and the speculation, because we've covered the production side, the nuclear fuel side, pretty intent in this one. But there are a lot of companies that are getting ready to start drilling, or they have just started drilling, and there's going to be a lot of essays that are flying out of the Athabasca Basin over the next 6 months. And so we're going to see all these drill results come in. But to the point we've already made, the big deposits like Patterson Lake and Arrow, they're not in production right now. Phoenix isn't in production right now, and it may be years. Hurricane was undeniably a fantastic discovery. Also, F3's discovery, I can't remember the name of the deposit, a fantastic discovery. You could argue that Pure Point's Spitfire deposit showed some promise. But there's about a dozen companies, Justin, that are all drilling, that are starting new projects, new land that hasn't been drilled. Even if they hit, does it matter?
It matters for the investors. It matters for the company. Usually getting some good hits and proving out some decent intercepts can do quite well for the company, for the shareholders. So in that case, it matters. You never know, if there's another, I guaranteed in the Athabasca, there's another Arrow out there. There's another McArthur River out there. Just a matter of finding it. So, it matters in the long term in terms of supply. These projects can eventually come online in a very, very long time. But it was Cigar Lake. I believe it was discovered in the 80s and possibly even in the 70s. It was a very, very, very long time before that started producing. And so that started producing, I think it was coming online during the previous bull market. And when that flooded during its ramp up phase was one of the reasons we saw the big price spike. But yeah, it matters to the company and the shareholders. Does it matter in the midterm supply situation? Probably not. But an asset like Hurricane, for example, that could get into production this cycle with Sabre. It's just a matter of getting the financing done, getting the permitting done, and all of that. So that's possible. I think that they've been kind of on the sidelines because Cameco is drilling right on the other side of the border and hitting. So that deposit crosses the border, and whether or not it'll be an eventual joint venture or a takeout, not really sure. But that's 50 million pounds at an average grade of like 30 something percent. It's absolutely insane. It's like $50,000 a ton rock. It's unbelievably high grade. So it will be mined. Will it be mined this cycle? Hard to say. Could it be? Yes.
Actually, I got one last one, final Jeopardy here
Sure.
for you.
Yeah.
We talked a little bit before this call about the weakness we've seen really since May. If you look at URNM or URA, they were trucking higher. URNM made an all-time high for that ETF, which has only been in existence about 4+ years, but in May. And in the last 2 months, things have fallen apart, and a lot of the sentiment has turned sour. Investors are hating the fact that they're invested in bag holding some of these companies because they bought at higher levels. But that's also a contrarian's dream. So are you looking at this as we may still have a contracted sell down in the mining stocks, or do you think we've already had most of the pain and people should be putting on their acquisition hats themselves and looking at how to scale into positions? How are you looking at it?
This is one of those situations that's very, very difficult to judge because there's kind of conflicting information, right? So on one hand, you have the uranium equities that are deeply, deeply oversold. The most oversold they've been in almost 2 years. I mean, I'm just talking, relative strength in the daily charts, right? Extremely oversold. There's some serious chart damage here. So for contrarians, like you said, this is a dream come true. You can talk to people like, the Rick Rules of the world, who, when they tell you, this is not just wishful thinking or them trying to cheer you up, when Rick or others like Rick will say that they actually literally dream of moments like this. If you have a strong fundamental outlook for something for multiple years going into the future and the market offers you a 30-40% discount, you should be rejoiced, assuming you have some cash to deploy. Now, this is something that we did recommend to our membership over the past 6 to 8 weeks, is that it's highly likely we're going to see some volatility. The S&P was printing all-time highs, and the uranium sector was moving sideways. So what do you do in that situation? Make sure you have some cash, because we'll probably see a bottoming in late July or early August in the uranium sector. This is literally what we said. So while we don't really trade around these sort of fluctuations, at least we did message to our membership that it's very, very important to maintain a cash position. And so, because moments like this come along and you want to be able to act on them. With that said, obviously, we've had a lot of influence in this sell-off, just like every other sector, although uranium got particularly hit hard, probably because of the dual factor, the Kazatomprom news, which, like I already mentioned, Shad, we think the market completely got that wrong and overreacted, but it is what it is. There were a lot of tourist funds that came into the space this year. All of the bullish news about reactor extensions and restarts and AI data center demand got a lot of these smaller funds frothed up and long the sector. And a lot of these funds just bailed on the sector in the last week and a half. And I can confirm that, right? We have contacts that have confirmed that. So that's one reason. But this Japanese carry trade unwind is something that I don't know how long this will take. And my understanding from macro people that I follow, who are far more intelligent than I am in terms of overall broad macro, the market is expecting rate cuts and potentially, I don't know if they're going to do an emergency rate cut, or we'll just see a rate cut in September probably. That sort of exacerbates the question, the spread between the rates in the BOJ and with the Fed in the United States, which should continue to put pressure on this carry trade for anybody that's borrowed yen and put that into the US markets in one way or another. So that's sort of had an influence on this. And if we see another liquidity event, that's going to hurt us. Doesn't matter what's going on. With that said, if we start to see the price move, or I should say when we start to see the price move, we're leading into the strongest season of the year for uranium equities. It's second half of Q3 into Q4. Almost every year is very, very strong for this sector and for the price of uranium. And considering the consolidation that the physical uranium has been in over the past 6-7 months, we think we're going to see a move. So if we do, and we start to see spot move and long-term price move and volumes come in, that doesn't mean that we are immune to a liquidity event. We probably are not. But that's something that's much more difficult for me to predict than looking at the charts, seeing the deeply oversold nature of this sector, seeing the fundamental setup for the sector, not only for the rest of the second half of this year, but for the next 3 to 5 years. And seeing these charts, it's very hard for me to not buy here. I told you before you hit record that I was relatively aggressive last week and into Monday into adding to my long positions in the sector, selling off some of my low conviction stuff in other sectors to fund some of that. So that was how I did it. But I don't know necessarily that this is the bottom. But as I mentioned, usually when people are publicly throwing in the towel on social media, When spot is at a 15, 16 plus % discount to NAV and RSI is below 30, every single time those three things have come together, that has either been the bottom or a few percentage points off of the bottom. And following those moments, we usually see a strong move to the upside. So that's what I'm personally betting on. That's what I believe is going to happen, with a big disclaimer that a lot of weirdness is happening around the world. A lot of weirdness is happening in the United States leading up to this election. We're seeing unprecedented stuff happening right now with the Democratic Party, with assassination attempts on the leading candidate. It's really, really ugly. And I have no idea what could happen between now and November or even now in January. So it's likely that volatility is going to be persistent in the markets and in the world in the coming months. What that means for uranium, I don't know. All I know is keep some cash, own some gold, but it's hard not to add to longs here in uranium leading into the strong season and with the backdrop that we've gone into deeply in this conversation. So I'll leave it at that, Shad.
Yeah, it's a great place to wrap it up, Justin. Some great thoughts too. And we will take that weirdness caveat and apply it to the markets because there is some wonky things going on. But when you look at the oversold nature, when you look at spot trading at a discount to NAV, as you mentioned, when you see the supply demand fundamentals, there could be that the uranium equities are still snared up in an all-out equity sell down, but it's becoming more and more compelling to look at adding to positions, or maybe people that bailed on the sector coming back in. And as more people bail, it gives the energy to where the next rally could build its base from and start from. So it's going to be interesting to follow along. I'm sure we'll be talking in another month or two. We'll see where things are at that time. And if people want to get Justin's real-time thoughts, definitely click on the link below this interview. It takes you over to Uranium Insider, where Justin is living and breathing this topic every day of his life. So definitely check out Uranium Insider. And Justin, we sure appreciate you doing a longer format discussion with us today here at the KE Report.
It's my pleasure, Shad. Yeah, it's very difficult to predict the short term, but it's hard to believe that accumulating at these levels in the sector. I didn't think we were ever going to see these prices again. So accumulating here, you close your eyes for a year or two, you're probably going to be a very, very happy camper, is my estimation.